Gina, this is one of those scenarios where there's almost always a bullish narrative this time of year because it is a quote-unquote seasonably strong time for the markets. But are there signs this time around that with the market's recent run that we may be due for that bit of a pause?
Well, there are a lot of signs that are, that suggest that there are still unpriced risks that are out there in the market. I think the biggest element I'm focused on is the one you actually just described, which is that credit card balances are almost back to normal levels. However, the carrying cost of those balances is significantly higher, and it is definitely having an impact on spending. And you're hearing that in earnings reports that, CEOs are tempering expectations going into 2024, Q1, Q2. And I think a lot of that is the question that we have is it going to be just a mild slowdown? We used to hear calls for recession, but a lot of that has been walked back because the consumer continued to spend because wages continue to rise. That was a good thing. It really did blunt the effects of seeing those rising interest rates. But I think we're starting to get to the other end of that, which is where consumers are going to have to pay for that excess spending.
If that's the case, when could we see some of the real impact from a market perspective? They tend to lead the economy. They tend to price these things in. They're a discounting mechanism. So is it in the first quarter of next year, the first half of next year? When exactly, what's the time frame on how that plays out?
So I think we'll start to see it in the first quarter of next year as we start to digest earnings from this holiday season. This is going to be an important holiday season as a bellwether for sort of how weak the consumer is.
And if that's the case, that all plays into the Fed narrative about how interest rate policy is going to be conducted in the coming months. Do you feel as though interest rates right now are going to be paused for a significant amount of time? Or do you think that there is still that inflationary threat out there, despite the fact that we're seeing lower oil prices, perhaps a cooling off in certain food parts of the market and whatnot?
So I think that that's definitely going to feed into the Fed narrative. If, in fact, you do see a weaker consumer, I think that's that's one of the pieces. Along with we're certainly seeing a lot more layoffs, and unemployment has been sort of moving in the direction that should be quelling the Fed's concern around demand and whether or not they can get a hold on demand. So I think that with the weakness in the labor market starting to finally show through, and the labor market is a tough one because we have so many sort of 55-plus cohort workers that just left the market and didn't come back. And so we just have a shortage of people in the labor market, and that continues to cloud that narrative. So I think if we have a considerably weak consumer, I think that could be enough to keep the Fed paused for the time being, and that would be bullish for the market generally.